All right, today we're talking about the US economy. And honestly, it feels like watching a high wire act. You've got all these conflicting signals, some really high stakes decisions being made, and just this incredibly narrow path to get it right. So let's dive in. So here's the big question, the thing that's got everyone scratching their heads. The Fed just cut interest rates. Now, normally, that's a reason for the markets to pop the champagne, right? But instead, there's this weird anxiety in the air. People are on pins and needles. So what gives? Well, it's because the real story is, you guessed it, way more complicated than just that headline. Okay, to really get why everyone's so nervous, you have to understand the biggest problem facing, well, everyone, from the Fed to Wall Street, the information they're all relying on, it's just not clear. It's like they're trying to navigate with a super blurry map. So, where's all this blurriness coming from? Well, it's a huge data lag. Think about it. The most important economic reports, the ones on jobs and inflation, they've been delayed. And because of a previous shutdown, some experts are saying we might not get a truly clear picture until, get this, early 2026. So decision makers are basically flying with old, outdated information. And here's where things get really tricky. The Fed's whole game plan is what they call data dependent. That just means they don't have some rigid, preset plan. They react to the latest economic numbers as they come in. But what do you do when the very data you depend on is fuzzy or late or just plain unreliable? Yeah, their job just got a whole lot harder. So this brings us back to our main character, the Federal Reserve, stuck in this classic catch-22. They're on that tightrope, right? On one side, there's the risk of hitting the brakes too hard and slowing the economy down too much. On the other side, there's the fear of letting inflation get out of control again. It's a heck of a balancing act. So, with their latest move, they clearly decided the bigger risk, for now, was a slowdown. They cut the federal funds rate down to a range of 3.5% to 3.75%. And just to give you some context, that's a 3-year low. So, it's a pretty significant move. But, and this is a big but, not everyone was on board with that decision. Far from it. Inside the Fed, there's a pretty serious debate going on. You've got one camp that's saying, yes, cut rates. We need to protect the job market before it gets weak. And then you have another camp hitting the brakes, saying, whoa, hold on. Inflation is still a huge problem. We can't declare victory just yet. Let's put a voice to that first camp. Mary Daly, who's the president of the San Francisco Fed, she called this rate cut a prudent decision, and her whole thing is being preemptive. She wants to act now to stop a problem in the job market before it even starts. That really tells you how seriously they're taking the risk of a slowdown. All right, now let's talk about the other side of that debate, which really boils down to one word: inflation. This is the single biggest headache complicating everything. It's that stubborn problem that just doesn't want to go away, at least not as fast as anyone hoped. And you can see the problem really clearly when you just look at the numbers. The Fed's magic number, their target, is 2% inflation. But when you look at the forecasts for late 2025, they're still showing inflation stuck up around 3%. Now, a 1% gap might not sound like a lot, but trust me, in the world of economics, that is a massive gap to close. And that's the bottom line, really. That stubborn 1% gap is like an anchor holding the Fed back. It's the reason they just can't go all in and start aggressively cutting rates, even though they're worried about the job market. They have to get inflation under control first. That's job number one. So with this whole complicated mess, what does the road ahead actually look like? Well, most forecasters are kind of on the same page for 2026. And the big theme isn't anything dramatic. It's slow and steady. Think gradual adjustment, not some big sudden shift. So let's break that down a little. GDP growth looks like it'll be stable, but maybe a little weaker than we're used to. What about unemployment? It's expected to hang out around 4.5%. So not a crisis, but not really getting any better either. And inflation? It's going to keep slowly coming down, but it's not going to hit that 2% target overnight. So the big picture here is an economy that's cooling off, but not falling off a cliff. So if there's one thing to take away from all this, it's this. Don't hold your breath for a bunch of rapid-fire rate cuts. It's just not in the cards. The Fed is going to be super cautious, super methodical. Every single decision is going to be weighed against that blurry data we talked about. Okay, so how do you keep track of this whole story as it unfolds? Well, think of this next part as your own personal dashboard. These are the exact same things the pros are watching to figure out which way this whole thing is going to go. you're going to want to keep your eyes on a few key things. First up, the CPI report. That's your big inflation number. Then you've got non-farm payrolls, which tells you everything about the job market. After that, look at the PMI. It's a great snapshot of what businesses are actually doing. And finally, watch the US dollar index and treasury yields. Those tell you how the financial markets are feeling about, well, all of this.
And all of this leads us back to that one huge, critical question. You always hear about the Fed trying to pull off a soft landing, right? Cooling down inflation without sending the whole economy into a recession. But with fuzzy data and with everyone inside the Fed pulling in different directions, the margin for error is basically zero. It's razor thin. So the question that's on everyone's mind is, can they actually stick this landing?